Tesla, my favorite stock in the world. The only company that you should own is Tesla. 100% Tesla, everybody. Anyway, welcome back to Strongman Personal Finance. I just got off work early because I started early, and I decided I'm just going to go dive into Tesla's financial statements, and I'm going to give you my opinion. So I'm going to look at I'm going to look at all the financial statements, and I'm just going to look at some of the metrics and see what I think about it. Now, keep in mind, ladies and gentlemen, excuse me, I am a Tesla bear in the short term because I think this stock is insanely overvalued. Now, people think this company is going to take over the freaking world. Well, guess what? No company controls the whole world. Unless it was Strongman Corporation, which I will form and dominate the world with one day. Anyway, so I'm going to go ahead and pull up Tesla's financial statements, and we're going to look at them. And if you guys don't know, I'm a certified public accountant, and even though I'm not a hot stock forecaster, I actually know how to read financial statements. So let's go check it out. And if you haven't already, like and subscribe to my channel because I give you no BS advice on how to actually build wealth. So let's go check out Tesla. What's up, buddy? Long Tesla or you're a boomer? I guess I'm a boomer. All right. So if you didn't know this, ladies and gentlemen, publicly traded companies actually have to provide what's called a Form 10K, which is an annual report on the company's performance. Okay. It's required to be publicly disclosed to the investing public, which is a good thing because you don't want to just invest in companies and not have any idea what's going on behind the scenes, because it could be the coolest sounding company in the world, but if you don't look at their freaking metrics and their data and analyze it, you have no clue what's going on. So before you even think about becoming an individual stonk investor, you need to at least know what a 10K is, and you need to know the basics of financial statements because you need to look at the company and what's going on with it. So this is Tesla's 10K, the Tesla Incorporated. I thought it was Tesla Corporation, whatever. So this 10K is as of December 31st, 2020. Now, one thing you want to keep in mind is that stocks are priced based on future expectations of the company's earnings, cash flows, et cetera, et cetera. Financial statements show the company's past performance, but you can use them to make kind of a prediction on where the company's going to go in the future. If the company's becoming more and more profitable over time, that's usually a good sign. If it's increasing its revenue over time, that's a good sign. So we're going to look, all right? So this was released, well, I don't know when it was released, but this statement is as of December 31st, 2020. So it's pretty recent. I don't know if they came out with a quarterly statement, but we're going to jump directly into the financial statements, which is my specialty because I'm an accounting hero. All right, the audit report, blah, 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 whatever. All right, so the first thing we're going to look at is the balance sheet. Now, if you don't know what the balance sheet is, it's going to show a company's assets, liabilities, and stockholders' equity. Now, a balance sheet is a snapshot at a point in time. A balance sheet does not show changes. Well, it does show changes, but it is not for a whole year. So if you had your own business and you wanted to make a balance sheet, you'd literally add up all your assets, your liabilities, and your equity at that specific date, and that would be what you would put on your balance sheet, as opposed to an income statement, which we'll look at later. So when you're looking at a balance sheet, obviously you got the assets, which is things the company has, liabilities, the company's debts, and equity. Now, there's all sorts of freaking ratios you can look at, but the main ratio you want to immediately look at when you're analyzing a company to see if it's not a complete train wreck is the current ratio, which is just your current assets, which is right here, divided by your total current liabilities. Now, what this means is it basically says whether a company can pay its bills in the short term. If a company has a lot of short-term bills due and it doesn't have a lot of assets to pay those bills in the short term, the company could be in trouble. So right off the bat, looking at Tesla, I'm sure their current ratio is fine, but let's go ahead and do the math. So their current total assets is $26,717. Now, we divide that by their total current liabilities, which is $14,248. So it's over 1, which is a good thing. If it's less than 1, that means a company might have trouble paying its bills and may have to raise, access debt to pay money, to pay its bills in the short term, which is not a good thing. So its current ratio is fine, and you can actually do a more stringent current ratio, which is called the acid test ratio, where you subtract out inventories and prepaids. So let's go ahead and do that. So we have cash of 1938 plus accounts receivable. Then we have inventory and prepaids. So that's their current assets, a more stricter version, divided by their current liabilities. So it's still over 1. So this company is not imminently about to declare bankruptcy. Tesla can pay its bills, which is fine. Okay. And another thing to note about a balance sheet is they actually show changes in accounts over time. So here in the left column, we have Tesla's assets, liabilities, and equities as of December 31st, 2020. And just for comparative purposes, because you can kind of see how like the ratios change over time, you have the December 31st, 2019 column. So we're not going to go super in-depth into Tesla. We're going to look at very basic stuff. But if you really want to go super in-depth in a company, you want to compare changes to year over year. But in my opinion, I think it's more important when you look at it from the income statement and the statement of cash flows. So no major issues. It's not going to go into debt. Another thing you want to look at is changes in common stock, which will be under the equity section of the balance sheet, because that basically says whether the company is issuing more shares, et cetera, et cetera. Because the more shares the company issues, the more your ownership in the company can be diluted. So looking here, it says common stock, you got the par value of common stock, which I actually don't see any changes. That's kind of weird. Interesting. We'll have to look more into that, but I don't see any changes in actual shares issued based on this. Okay, 960 and 905 issued and outstanding. Okay, so it looks like they did issue about 55 shares. I guess these are in millions. What is this? Yeah. So they issued about 55 million shares between 2019 and 2020. So just keep in mind, if a company's issuing a lot of shares and you see a trend, that could mean that your earnings per share is going to be diluted if you're a current shareholder. So you want to keep that in mind. So you got to really dive into these statements to see all the details. All right. So now let's move on to the consolidated statement of operations, also known as the income statement. Now, I like the income statement because it shows your profitability. And you can look at profitability from several different metrics. You can look at a company's gross margin, which is its profitability before you factor in any operating expenses, interest, and taxes. You can look at its operating margin, which factors in a company's profitability after paying for cost of inventory and operating expenses, paying the CEO, et cetera, et cetera. And then you can look at net income, which is on the bottom, and that shows a company's bottom line profitability. So ideally, you want to have a positive operating income, and you definitely want to have a positive net income because that shows the company is actually profitable, at least from an accounting sense. So they have 3 years of income statements. And right off the bat, you can see with revenues, they have growing revenues. So you look over at 2018, for example, automotive sales revenues was $17.6 billion. And then we have growth to 19 billion and then to 26 billion, which is nice. That's what you want to see. You want to see a business's sales growing, but that's before you even consider profitability. Revenues is not profit. You can have $1 zillion in revenues, but if you're not profitable, it doesn't freaking matter. You're not making money because your business also has expenses that are going to offset those revenues. So another funny thing I noticed, and when you look at the revenue section, they have automotive sales, automotive leasing, total automotive revenues. And then they have energy generation and storage and services and other. Now, people say all the time, Tesla isn't just a car company, okay? Tesla also does a bunch of other stuff. Well, let's see what percentage of Tesla's revenues are from automotive sales. So total automotive sales in 2020 were 27.236 billion. And total revenues, considering all the other stuff, was 31 billion. So with my trusty dusty calculator, we're going to see what percentage of Tesla's revenues are from car sales, because it's not just a car company. 86% of Tesla's sales when you factor in sales of vehicles and leasing is car stuff, okay? So Tesla is basically a car company with some crap thrown in on the side. So the last thing I want to hear from anybody in the future is that Tesla's not just a car company. They're going to take over the world. I don't see that yet. 86% of their sales are automotive. Let's see what the percentage of sales it was for last year. So 24, 5, 7, 8, 84%. So Tesla's percentage of sales for cars has actually gone up by about 1 or 2% from 2019 to 2020. So it's almost like they're becoming more of a car company, but they're not just a car company. And then let's look at 2018. 18,515. And I'm sorry if you're bored with all this math. I know you just want to have Tesla go to the moon for no reason, but I actually like to look at statements. All right, so it was 86 in 2018. So I'm seeing kind of a stable trend. You had 86% of sales were automotive in 2018, 84% roughly 2019, and then about 86% in 2020. Tesla is a car company, okay, with a little crap thrown in on the side. So when you're looking at this, you can also calculate your gross margin. Now, your gross margin is how profitable you are just factoring in the cost of sales. So, for example, Tesla has to spend money to build their cars. Let's say the Model S. So they put money into the car. They have to do labor, many materials, overhead. That all gets capitalized into inventory. And then when they sell it, that is their cost of sales. It costs Tesla money to build the stuff that they sell, and they should be selling it for a higher price than it costs them to make it. So if you want to see Tesla's gross margin, which is just their cost of their sales minus their cost of sales, we'll go and figure out what that is. So, for example, automotive sales in 2020 were 26 billion. And the cost of automotive sales, this is how much it cost them to build the cars, was 19,069.6. Oh, it's got 69 in it. That means you have to buy the company. So let's see what the gross margin was. So 26,148 minus 19,696 divided by 26,184. 25%, okay? That's not bad. I mean, I don't know how that compares to the car industry, but it seems like a decent gross margin. Now, let's see how that gross margin has changed. So you want to at least see a stable gross margin or even an improving gross margin, because that means the company is, having better production processes where they're actually lowering the cost of their inventory. So let's go back to 2019. So automotive sales were 19,952. And automotive sales, cost of sales was 15,939 divided by 19,952, 20%. So they actually improved their gross margin, which is a good thing, at least from 2019 to 2020. And then let's see what it was for 2018. So 17,632, 13,686 divided by 17,632, 22. So it went from 22 to 20 to 24. So I would say average of 22, 23% gross margin, which whatever. I don't know how that compares to the car industry, but at least they're profitable in that aspect. All right. So then we go down. So we look at the cost of sales, and that gives you your gross profit. Now, obviously, you want a positive number in your gross profit, because if you don't even have a positive number in your gross profit, you're not going to be profitable anywhere else. So it looks like their gross profit was flat for 2 years, and then it went up. Cool. That means they sold more stuff. All right. Now we go on to operating expenses. This is the cost of running your business. Now, Tesla's, kind of a new company, so they're probably going to be pumping a lot of money into R&D. So just because their operating income might not be super high, that could simply be because they're putting a lot of money into R&D. Now, what you want to watch out for is if they're spending too much money on selling, general, and administrative expenses. That means they're paying a lot of money for their staff, the CEO, stuff like that. So when you're doing the analysis, you want to make sure that this is growing, proportionally to revenues, or at least staying stable or starting to fall as a percentage of revenues. So let's see. Oh, crap. I just lost it. Oh, of course. Everybody's leaving now. Consolidated statement of revenue. Oh, I hate this freaking computer. Come on. Oh my God. I lost it. All my fans are unsubscribing. All right, we're back. Please don't go away. Damn it. There we go. All right. I'm just trying to zoom in. Whatever. We'll have to zoom out a little bit. So, selling general and administrative expenses as a percentage of revenues for 2020 were, and like I said, the only reason I'm doing this, I want to see how they're controlling their actual operating costs. R&D, I'm not really worried about because with research and development, I mean, that's just part of a normal cost of business, especially for a company like Tesla that's expanding. So selling general administrative expenses were 3.1 billion and revenue was 26 billion. So about 12% of Tesla's revenues went to basically running the company, sales costs, CEO salary, stuff like that. Now, the previous year, we had 2646 divided by 19952. 13%. All right. So it looks like it actually went down. That's a good thing. You want that to be going down. So cool. So the next thing we're going to look at is income or loss from operations. So as you can see, Tesla was generating a loss from 2019, but they actually had a nice, decent little delicious operating profit in 2020. Oh my God, this freaking thing. Oh my God. This is going to piss me off. All I want to do is look at the financial statements. All right. Sorry. So just to orient you back, we're looking at income loss from operations. So this is your operating income. That's before you pay interest and taxes. So, you know, they had a pretty big loss, 388 million in 2018. Then they had a 69 in 2019. And then they actually had an operating profit of almost $2 billion in 2020. So the company is actually improving and becoming more profitable. Now, does that mean it's going to take over the world? No, it's not. All right. So from your operating income, you got to pay interest on your debts. Okay. So actually looking at Tesla's interest, I don't see a crazy amount of interest payments. Oh, that's interest income. Excuse me. Interest income, whatever. Interest expense is going up. So what that means is the company's probably borrowing a bunch of money to finance expansion. It's not the end of the world, but you want to at least make sure that you can cover your interest payments. So income loss before income taxes. All right. So basically, if you have a gain, you got to pay taxes. So your net income, which is, okay, net income loss attributable to common stockholders. So there's probably a non-controlling interest, which means Tesla bought out maybe another company, but it didn't fully buy out another company, which is why you would have a non-controlling interest. But what you really want to worry about is if you're a common stockholder in Tesla, you want to look at net income attributable to common stockholders. So what is Tesla's overall profit margin after subtracting out all your expenses? 721 million divided by 26,184. 2.75%. Okay, that's just a massive blowout, profitability right there. So is Tesla profitable? Yes, it is. Are their profits just mind-blowingly amazing? I don't know. I mean, that looks kind of low to me, but I don't look at the car industry, so I can't tell you necessarily. But on a positive note, the company is increasing its revenues every year. Its gross margin is staying stable, and its operating income has increased, and it's actually profitable on the bottom line, which is a good thing. You want a company to become profitable because you don't want to invest in a freaking company that doesn't make money. So that's the income statement. So there's a lot of stuff you can do here. Now let's move on. And that's just a small, quick analysis. So don't take this as like, oh, I'm going to make my decision about Tesla or not, even though I say don't buy it. Now we have the statement of redeemable. Okay, screw that. I want to see the statement of cash flows. Now, one thing I want you to keep in mind is that when you're looking at the income statement is not based on cash. Now, accounting has this thing called accrual accounting, where you recognize revenues when they're earned and you recognize expenses when they're incurred. So just because a company hasn't paid cash for an expense, or just because a company hasn't collected cash from a sale, that doesn't mean they haven't earned it. So when you're looking at that income statement, that's based on the accrual basis. Now, the statement of cash flows actually shows you where the company's cash is coming from and where it's going. So you want to factor in both. You don't want to just look at the income statement and say, oh, company's good to go. You also want to look at their statement of cash flows. Now, the statement of cash flows is divided into three main sections. You have the cash flows from operating activities, which is basically money going in and out for what the company does. You have cash flows from investing activities. That's buying and selling property, plant, and equipment. Maybe if they have like investments in stocks or I guess even Bitcoin if they did that. And then cash flows from financing activities, which is the company raising money through either debt or equity and paying dividends. So this is all about cash. Statement of cash flows, cash. So when you're looking at this, the main thing you want to see is positive cash flows from operating activities. That means the company's actually generating positive cash flow from what it does. So looking at Tesla, I mean, you go back to 2018, they were showing positive cash flows from operations, and it's increasing with a massive jump in 2020. So that's a good sign. You want cash flows from what you're doing to be positive. Now, you see all this stuff here, they're all adjustments because you have to adjust from the accrual basis of accounting to the cash basis, basically. So all this stuff here, I mean, if you really want to dive into it, you can, but you have to make adjustments for non-cash expenses, non-cash revenues, depreciation, amortization, stuff like that. And that's how you figure out cash from operating activities. So just looking at this, that's a positive sign. You should see a positive number for statement of cash flows from operating activities. So next you look at statement of cash flows from investing activities. Now, a growing company is going to have negative cash flows because they are going to be spending money on acquiring assets to grow their business. So just because looking at this, I see negative cash flows from investing activities, that's not a bad thing. For example, looking at 2020 here, they spent $3 billion on buying property, plant, and equipment, excluding financing leases. And they also purchased solar energy systems. Wow, 75 million as opposed to 3 billion for looks like mostly car stuff. And blah, blah, blah. Receipt of government grants. What's going on there? Looks like Tesla's being a little subsidized by the government. But yeah, so, oh, Jesus. So you don't necessarily want to freak out because you see negative cash flow from investing activities. The main thing is that they're actually spending it on good stuff, building new power plants, whatever, which Tesla's doing. So now we have the statement of cash flows from financing activities. Financing is when a company raises debt or raises money either through issuing bonds or issuing stocks. So you can see, for example, proceeds from issuances of common stock in public offerings net of issuing costs. So they raised more than $12 billion in cash from issuing stock, which I don't blame them for doing because the stock price is so ludicrously high that they can make a freaking fortune issuing stock and collecting cash. On top of that, you have proceeds from issuance of convertible and other debt. So that's the two main ways that companies can raise money. They issue stock, they give up ownership of their company, or they go into debt. Now, there's benefits to both, which I don't want to get into now, but it's not necessarily a good or bad thing to have both. It all depends on what you want your capital structure to be. All right, so we have that, and then we have repayments of convertible and other debt. You got to pay your debt back. Cash is going to go out for that. And then you look at the very bottom, you have net cash provided by financing activities. They got almost $10 billion from stock issuances and debt after paying off their other debts. So when a company's growing, you want to see the company raising money to grow its operations. But you need to be careful because you want to make sure the company isn't going into too much debt or it's giving up too many shares because that dilutes your earnings if you are a current shareholder. So these are trends you want to keep in mind. So if Tesla keeps giving out stocks, we're going to issue more stocks. Well, that could be a bad thing because it's diluting your earnings. So overall, not too shabby. I mean, it's not a bad company. It's profitable. But even this analysis I just did, it's not thorough enough to really make an investing decision. There's a lot of stuff that goes into whether you make the decision to invest in a company. Now, when you have this Form 10K, they also have notes to the financial statements. You want to go in there because you want to dig into the details to see what's really going on. These financial statements, they're a very cursory overview of what's going on. But you want to get into the nitty-gritty to really understand why some of these accounts are the way they are. Because companies can hide crap and manipulate stuff all the time, and it really takes digging into the notes to figure that out, which I don't want to do for Tesla. Now, looking at it, even though it's profitable, and even though it has positive cash flows from operations that are growing, and even though its revenue is growing, I don't care, because it's not just about whether it's a good company or not. It's about how much you're paying for the company's earnings. That's what ultimately matters when you're investing in a company. If you want to get $1 of earnings per year, how much are you willing to pay for it? And how much do you think that company's earnings are going to grow into the future? And do they meet your expectations for your required rate of return? So you want to be really careful, especially with a company like Tesla, where people will say, oh, see how much the revenue's growing and the net income's growing and the cash flows are growing. That doesn't mean crap if the projections of the company's growth are entirely too optimistic, which I think they are, because I don't think this company is going to take over the world. And I think it's completely ludicrous that this company's shares or this company's valuation is as big as the next 10 car companies combined. It's ridiculous. But you need to do your freaking research, okay? Oh, we got some viewers here. All right. Long Tesla, you're a boomer. Yep, I'm a boomer. Me Kevin owns 50% of net worth in Tesla. Yeah, me Kevin is a clown, okay? Even though it's a profitable company. I mean, I'm not saying it's not. I mean, I haven't really dug into the notes, but it's profitable. It's got operating cash flows that are positive. It's expanding. But that doesn't mean you put half your portfolio into one company. Because if one thing goes wrong, if the company doesn't meet investors' expectations and then the stunk crashes 50%, you've lost about 25% of your net worth. So I know for a lot of us, it's common sense. Okay. You don't put all of your eggs in one basket. But for some people, like Meet Kevin's fans, they're just whatever. Meet Kevin is not somebody to follow. Okay. And I'm not saying I'm a stock genius, but at least I'm smart enough to know not to put half of my net worth into one highly speculative, very expensive stock that people are thinking is going to take over the world. Meet Kevin thinks Tesla's worth 6,000. No, I don't think it's worth 6,000 a share. Maybe in like 2250 if the company's still around at that point. But I mean, I actually watched an analysis of that video. There's actually another YouTube channel. I think it's called Everything Money. And I think they actually dove into that projection. And they were saying that if Tesla was going to be 6,000 a share, that would mean Tesla would be a $6 trillion company in the next 10 years, which is enormous. That is literally like 3 times as big, I think, as any company that's around right now, which is just ludicrous. Okay. I mean, it could be a great company. That doesn't mean it's going to be worth $6 trillion in the next 5-10 years or whatever Kevin's stupid expectations are. But even if he's right, I mean, even if let's say he is right, it's still not worth the risk to put 50% of your portfolio into one stock, because the downside risk, in my opinion, for Tesla is much greater than the upside risk. Okay. I mean, yeah, Tesla might be a $6,000 company, 6,000 per share company. It's highly unlikely. What's more likely is that Tesla actually isn't worth 10 times it isn't worth the next 10 car companies combined. And if that becomes the case, then the stock is either going to be flat or it's going to fall. So I know you guys are smart enough not to put half your net worth in Tesla, but you know what? If you guys just love the stock, whatever, no more than 5% of your portfolio, their profits will go through the roof once the Cybertruck comes out. I mean, I don't know. I don't know what their gross, because you have to look at, it's not just like, oh, how many Cybertrucks do they sell? Well, what is the cost of sales? How much does it cost them to make the Cybertruck? I mean, we'll have to see. And no, because most of sales. All right, guys. Well, that's it. Go ahead and like the video. Subscribe to my channel if you haven't already. I know, have you even seen this much analysis on YouTube? And that was like a very simple analysis. Now, I'm not a financial advisor or a genius, but I at least know how to, scan over financial statements. Now, I know you probably don't see that on me, Kevin. He probably just craps out some numbers. Yeah, that's actually, if you guys haven't subscribed to Everything Money, that is actually a fantastic show. Now, they go into individual stocks, which I'm not a fan of because it's very risky. But if you want to learn about how to actually analyze stocks, that's a great place to go. They actually put out good information, and I actually recommend them. Just don't get all swept up into buying individual stocks. I don't agree with them on that. But that's it, unless you have any more questions. I have to tutor. No questions? Like, subscribe, tell your friends about me, share me. I need to grow. I need that YouTube money. All right, I'll talk to y'all later. Cheers.